Hello, everyone, and welcome to Economist Unplugged with Praful Raj. This podcast is an insightful conversation with economist and professor where we will deep dive into the Indian economy. Today, our guest is Dr. Gurbachan Singh, a well-known independent economist. He was previously visiting professor at Ashoka University. He had earlier taught in Indian Statistical Institute and Jawaharlal Nehru University. His academic writing is primarily focused on macro financial stability. He writes a monthly column in Business Standard and has a significant contribution for Ideas for India. Currently, he is focusing on his upcoming book on asset prices and macroeconomics, thinking afresh on basic principles and policy. Thank you so much, Professor, for joining this podcast.
Thanks for having me. I'm really glad.
Thank you. So today we'll talk about the interest rate policy because as consumer, it is very important to understand the policy as it directly impacts our borrowing capacity and the purchasing power. For example, during period of recession like COVID-19 and global financial crisis, central bank worldwide reduced interest rates to influence economic condition. In the context of India, it is known as the repo rate, while in the US, it is referred to as the federal funds rate. Talking about the recent example, during COVID-19, central banks worldwide slashed interest rates to support their economies. However, economies recovered, but inflation surged. Central banks have been aggressively raising rates since 2022. So today, our speaker has a different view on how we make monetary policy more effective with fewer cons. My first question to Professor is on the very basic understanding of this topic, uh, that Professor, when central bank adjusts interest rate, RBI and Federal Reserve Bank, what measures do it what measure does it implement, and how rapidly these changes impact the general public's financial circumstances?
So the usual standard policy is the interest rate policy. Interest rate is the main policy tool with the central bank, whichever central bank it is, whether it's the Federal Reserve in the US, the RBI in India, or any other central bank in any other part of the world. The idea is to increase the inflation rate, increase the interest rate when it is inflation or an unhealthy boom. You reduce the interest rate when there is a recession or the inflation rate is lower than the optimal rate. So it is this which is used as the main policy tool. There is a serious difficulty with this, though. The serious difficulty is that this has adverse side effects. And moreover, it is not even very effective because the central bank has more than one objective, but it has one main policy tool. So it is not very effective and it has side effects.
So, Professor, coming back to the effectiveness of it, if you can tell us that, so suppose the RBI or Federal Reserve Rate, whoever the central banks, they increases the interest rate. So what actually happens? So for example, like tools, like what are the tools used in India? They use GSAP, right? So if you can talk a little bit about what exactly happens, and what does RBI do, take an action, and then probably we'll come to the effectiveness. That then we'll talk where the where the problem is.
So the context for all this is managing the aggregate demand in the economy. So if the aggregate demand is low, then you reduce the interest rate, and what you're expecting is that the real investment in the economy, setting up a factory, a showroom, a shop, any business investment, that will pick up. Also, real home construction would pick up, the purchase of consumer durables would pick up, and that will increase the aggregate demand in the economy. Now, while you're doing this, there's an issue of transmission of policy. So what you're doing is you're affecting the interbank rate, really. Federal Reserve, federal funds rate is the interbank rate, and the Federal Reserve is targeting that interbank rate, and it is trying to influence it through changes in the quantity of money which are under the control of the central bank. So, but the policy needs to be transmitted to the businesses and the consumers. So from the interbank market to the business and households is a big step. Now, firstly, because the interbank market rate is a short-term rate.
Yes.
But what you are trying to do is to affect the long-term rate, because that is what matters more for aggregate demand. And then you are trying to move from the interbank rate to the rate which is charged by banks or which is effective in the bond markets. So these two make the process difficult. But that is not my main point. My main point is that if the central bank has, for simplicity, two objectives, let's say maintaining low and stable inflation and maintaining full employment, then they have one main policy tool with which to handle two objectives. And that's where you have a paucity of policy tools, which is what makes the policy not very effective. Now, this is well known. The other part, which is less well known, or at least less well appreciated, is the side effects of the changes in interest rates which have to be made now and then.
So if you talk about like side effects, so if you can point out what exactly the side effects, and before that, like I'm just thinking that it's been like decades and decades this the interest rate monetary policy of increasing and decreasing the rate happens, but why like like central bank economists and all try to work on these side effects, like why it has not been implemented? Because I'm sure that the side effects is not known, it's well known in the market. So what
So,
apprehensions comes to for them?
yeah, so it is well known, that is true.
Yes.
But what happens is that if you have a paucity of policy tools and you cannot help having the side effects, then you don't want to pay much attention to the side effects, because your argument is that, well, what can we do anyway? And it is in that context that I'm saying, no, there is an alternative policy which can be effective as well as well targeted, at least compared to the prevailing familiar policy.
So as per you, what are the side effects? If we can talk a little bit about what exactly targeted side effects that we know, but there are various reasons that we overlook these side effects.
Yeah. So let me take an example from the US from 2023, early part of 2023. As you know, the Fed was in the process of increasing interest rates
Yes.
from the low rates that had been reached during the COVID period. After that, the inflation got very high, almost 10%. And to fight that inflation, the Federal Reserve started raising the interest rates substantially and quickly. And what that did was that the prices of the bonds fell. Now, these are government bonds which are supposed to be saved. They are safe in the sense of the default risk. They are not safe in the sense of the credit, in the sense of the interest rate risk. So when the interest rate goes up, we have the inverse relationship between the interest rate and the bond
Bond
prices.
prices,
The
yes.
bond prices fell. Now, it is not very well known that in about 3 years' time, a 10-year or a 30-year government bond fell by almost half in
Yes.
the US during that period. Now, this is supposed to be a safe asset. Now, a common man cannot make a distinction between, you know, default risk, interest rate risk,
Risk,
etc.
yes.
So they have a serious problem with that. And people who had invested in government bonds around the period of 2020, they almost half the capital was lost. We are not talking about the stock market. We're talking
Yes,
about the bond market,
bond
and
market,
that too
yes.
government bonds.
That
So,
inverted yield happened like in last I mean still it's the bond curve is inverted.
so there are two things. One is the inverse relationship between interest rates and bond prices, which is what I'm talking about. The other is the inverted yield curve. Now,
Yes.
that's a slightly different issue.
That's a secondary thing, yes. Yeah.
Yeah, we can keep that aside. So firstly, investors lost a lot of money, and this is the common people. The other part is that the banks in the US which are holding a lot of government bonds, like Silicon Valley Bank,
Silicon
and
Valley,
there were others.
it happened, yeah.
So suddenly their loss was very high, and they faced a bank run, which turned into a panic run as well. And then it became an issue of not just asset price stability, it also became an issue of bank stability.
Yes.
So that's where the effects are there. A little more on the side effects. At the time when the interest rates were being reduced during the COVID period and after the global financial crisis, this reduction in the interest rates hurts the interest incomes of the middle class. Now the rich tend to invest in stock market and real estate. They don't really invest in these bank deposits, etc. So again, the interest incomes were reduced for the
For
common
the
people.
common people. Yeah.
Yeah. So there are two issues. One is the issue of redistribution. The other is the issue of stability. So when I was talking earlier about Silicon Valley Bank, etc., that is the issue of banking stability or financial stability more generally.
In
The
general.
other is the issue of redistribution. So both are the side effects of the prevailing policy.
Yeah. So you talked mainly about the US market. If we have some examples in India, if that you can quote, what exactly? Because as we all know that in RBI tightens the bank regulation so much that it's difficult for Indian banks to fall down or to go like bankrupts. It's not easy for Indian banks to go. So what could be the side effects of these interest rate policy in terms of Indian market?
So I'll give an example. Initially, when the current governor, Shaktikant Das, came to the RBI, the Indian economy was facing a slowdown.
Correct.
It was 2018 or 19, somewhere there, before COVID period.
COVID period.
And they were keen to give a push to the growth rate of GDP. And the RBI loosened the monetary policy. Now, the policy was loosened to deal with the growth recession, if one may call it that. But in the process, what happened was that the inflation rate picked up. So inflation in India picked up well before the COVID period. And that was a side effect of the policy which the RBI used for dealing with the growth recession in the economy. So
Okay.
that
Yeah.
is one example. But in India, there is, besides these issues that we are discussing, there is the other important issue of financial repression, real rates being kept low. But that is a different aspect from what we are discussing here.
So one aspect which I can see from the consumer point of view that the bank deposit, the interest on the bank deposit goes very low. So for common people, it's a problem. So the interest rate on a fixed deposit or on a general account, it that becomes a little bit low compared to other economies. So talking about that, if we so I read your article on the new policy. So you talked about the quasi tax subsidy scheme, and then you mentioned that in the new interest policy that you are suggesting there should be a clear tax subsidy scheme where the finance minister department, the finance ministry department should also play a role. So if you can talk a little bit about that, what exactly your new policies and what does these tax subsidy scheme means?
Okay. So let us, before we come to this, let us understand what the current policy is.
Yes.
Because that is how we will come to the new policy. So when the central bank lowers the interest rate, it is as if it is giving a subsidy to borrowers because it is reducing their interest cost. And when it is reducing the interest rate, it is also reducing the interest income of the recipients of interest income. Now, it's as if you are taxing the depositor or the lender. So, with a reduction in the interest rate, the central bank is actually using what one may call a quasi-tax subsidy scheme, which is implemented not by the Treasury or the Ministry of Finance, but it is implemented instead by the central bank. Now, when you have this subsidy for borrowers and tax for the depositor or the lender, then the question arises, if we do have a tax subsidy scheme, though of an implicit kind, even non-transparent kind, then why can't we have a clear, transparent tax subsidy scheme by the Treasury or the Ministry of Finance? Now, the moment you start thinking in those terms, then you're not merely replacing a quasi-tax subsidy scheme by a clear tax subsidy scheme. What you are ending up with, and this is what I show in my forthcoming book, is that because a part of the role is being performed now by the Treasury or the Ministry of Finance, that leaves the central bank free to do some things which it was otherwise constrained to do. Now, given that you have a clear tax subsidy scheme by the Treasury or the Ministry of Finance for the purpose of affecting the interest rate, obviously the interest rate can no longer be the policy tool with the central bank. But what can be a policy tool with the central bank is the quantity of so-called base money. So what we have is a situation now where the central bank has one policy tool, the base money, and the Ministry of Finance or the Treasury has the other policy tool, which is the clear tax subsidy scheme by which to affect the interest rate. This is how I am addressing the issue of paucity of policy tools. And since you no longer face the paucity of policy tools, the policy becomes effective in dealing with two objectives. The two objectives here being inflation and full employment.
So I have two questions in this. We'll talk like the base money and the clear distinction between the Ministry of Finance and the central bank. So one, the very fundamental reason of lowering the interest rate is to reduce the demand. Now, as per the argument that you are giving, that the deposit rates or the normal banking rate will go down, which will decrease our income as an interest income. So isn't that the policy want, policy does that, like that's the motive of policy, to bring the interest rate down and reduce the demand by reducing their interest income?
So I think there was a slight slip of the tongue when you were discussing this. So
Okay.
when you reduce the interest rate, you're trying to increase the aggregate demand. That's what you meant. But
Yes, agree. Yeah.
that's what you meant.
Oh.
Okay. So you reduce the interest rate to increase the demand. Now, this is what is familiar under the prevailing policy.
Yes.
So what I'm saying is that you do the same thing in a well-targeted way and in a more effective way under the proposed policy. So how does it work? So if the Treasury or the Ministry of Finance gives a clear subsidy, then this subsidy is going to increase the demand for funds.
What kind of you are talking about, the normal tax subsidy, or like what
Yes,
kind of?
a
Yeah.
normal subsidy. So just as you give a subsidy on, say, fertilizer or
Okay,
on food, you
okay.
similarly give a subsidy on the interest cost incurred in borrowing for the purpose of real investment or housing or maybe even consumer durables, but not for every kind of borrowing. So what this means is that some Warren Buffett cannot borrow at a
At a
low
lesser rate.
subsidized in order
Yeah.
to invest in the stock market. This is
Okay.
not to single out Warren Buffett.
Yeah,
It's
I
just
understand.
a more
Yeah.
familiar name.
Yeah.
So coming back to the argument and how it works. So what a clear subsidy to reduce the interest cost does is it increases the demand for funds. So since the demand for funds is increased, the interest rate that we observed in the market, that interest rate will rise in the recession from the low level that it reaches in a recession. But this happens alongside the effective interest rate. Effective interest rate is the post-subsidy interest rate.
Interest rate.
That is reduced in a recession in order to give a push to real investment, consumer durables, housing, etc.
Etc. Yes.
So on one hand, you are normalizing the interest rate observed in the market. On the other hand, you are reducing the effective interest rate for some purposes to the low neutral rate. So in a recession, as we know, the neutral rate is low. In a boom, the neutral rate is high.
Yes.
So the effective rate for borrowers for the purpose of real investment is being reduced to the neutral rate, but the interest rate observed in the market is normalized. So what happens is that on one hand, the policy is effective in taking care of the aggregate demand. On the other hand, since the interest rate observed in the market is being normalized, the adverse side effects on interest incomes, on banking stability, on asset price stability, these are being avoided.
Okay. So, I mean, I'll just summarize if I understood correctly. So, you are saying that, keep that policy of decreasing the interest rate, but on the other side, give subsidy on the deposit rates, the which kind of, subset the impact of declining interest rate.
So just a small change here.
Yes.
So not a subsidy on the deposit interest rate.
No, and
Uh,
subsidy on the overall, like, a consumer subsidy, maybe agriculture subsidy, electricity which increases the demand, which does not reduce the demand.
so a subsidy, uh, you get a subsidy if you are a borrower, not if you are a depositor or lender.
Okay.
And if you are a borrower for the purpose of real investment,
Okay.
that's where the subsidy comes into the picture. So the lenders and the depositors are not being touched here. It's only the scheme for the borrowers, unlike the prevailing policy where the effect is not just on the borrowers, but also on the lenders and depositors.
Lenders.
Let me elaborate a little on this. The purpose of policymakers is to reduce the interest rate for borrowers. But under the prevailing policy, if they reduce the interest rate for borrowers, they also have to reduce the interest rate for depositors and lenders, which is
Yes.
where it gets blunt,
Blunt.
which is what is avoided under the proposed policy.
Okay. uh, okay, so since I'm sure that in the proposed policy, there might be some side effects or like some cons. So if you can think of what could be the cons of the proposed policy. Yeah.
So on the negative side, there is an issue of interdependence between the Ministry of Finance and the central bank. They need to interact with each other in formulating the policy, because one policy tool is with the central bank, the other policy tool is with the treasury.
Treasury.
So there's an administrative issue and maybe occasionally a political issue. But the benefits are substantial. The other part is the administrative cost. When you have the central bank giving a quasi subsidy or imposing a quasi tax, it doesn't require administration. It just requires a change in policy at the level of the central bank. Whereas under the proposed policy, there is an administrative cost. But I should quickly add that in any case, companies, banks, households file tax returns. So it's just a matter of including some more things in the tax returns rather than, an overall of the tax administrative machinery.
Okay. So also, like, since we discussed about this interest rate policy, so I mean, you will be proposing in a new book. So let's talk about, like, how is the current Indian economy performing, like, from your perspective.
Oh, the current Indian economy is of course doing well. 6.5, 7 there about, that's where we are. So it is very good. I'll say I'll add two more things to it. One is that even though this is impressive, it's a little less than our aspirational levels, and also what had been achieved in Japan or South Korea and other places at that stage of the development. The other part that I would like to bring to attention is that even though we have come to the growth rate that was there pre-pandemic. But during the pandemic, we had fallen so much that though the growth rate has been revived, the growth path, the level of the growth path has not been brought
Attained.
back, attained. So we are at a growth path which is parallel to the earlier growth path, but at a lower level. There is a nice graph from Raghuram Rajan in this context. It is available on YouTube.
So one thing, like I ask every economist whenever I have such conversation, like that's out of curiosity. Like we boast that our Indian economy is growing like 6%, 7%, and it grows up to like $5 trillion. We have a target of doing that. But one thing that we miss every time is that this growth is not actually a real growth in terms of policy or decreasing the inequality. It's Isn't it the consumption based growth, because we have a population 150 crores. Like a small consumption reaches, it will increase the GDP. So I mean, I'm not denying that we have seen a growth compared to last 1.5 decade, but isn't that this growth is not as you mentioned aspirational, and also like isn't just a consumption based growth, so we should not just boast about it like, oh, you're going to 3 trillion to 5 trillion economy. So what's your view on this?
Of course, there are other issues. Um, Per capita income is very
Yes,
low.
exactly. That's a right. That's the very
The,
good way to question my reiterate my question, that the yeah, exactly, the per capita income is not growing actually, and the
well,
gap
no,
is also,
I
yeah.
will not say that per capita income is growing, but it is at a very low level
E-
currently. It is still
Exactly.
low. And the other part is, which is I think the concern you have in mind, is the uneven distribution. Because even if the per capita income is growing, if it is growing at a high rate for some, but at a slower rate for others, also we have a big issue of youth unemployment,
Yeah,
etc.
it's kind of a
So
K-shaped growth. The the richer are becoming richer, and the poor are becoming more. I mean, the middle class, the savings the middle class saving has of course gone down. So isn't the K-shaped recovery, we are not recovery,
so
but K-shaped growth kind of?
So during COVID period and soon after COVID, it was indeed K-shaped. But now, while those who are well off are getting even more well off,
Yes.
I am not sure that those who are poor are getting poorer, or those who are middle class are getting into a lower position. That is a stronger assertion. So something of that did happen around 2020, but that phase seems to be over, which is not to say that there aren't concerns. We need to deal with them. I would just like to say one thing, which is connecting the current discussion we are having with the discussion we had a little while ago,
Yeah.
which is that in India, and as I can see from your questions also, there's a lot of focus on development economics, which is understandable, and which is very understandable. But what is happening is that in the process, we are paying less attention to other important fields, whether it is macroeconomics or
Yeah.
finance. So I'll give you just one example from the viewpoint of development economics itself. During COVID, we fell massively. Now,
Yeah.
that was an issue of macroeconomic instability, of course, supply side, not just demand side.
Yes.
Now, if we had better macroeconomics and finance, then we could have helped the poor. We could have
Better.
helped the
Yes.
economy develop and grow better. So we can help the economy not just through development economics or growth economics.
Yes.
The macroeconomics and finance are also very important in ensuring not just stability, but relatedly to maintaining the growth path over a long period of time.
Yeah, I mean, I understand, like, yeah, it's not like poor people are getting more poor, but the thing is that the spending has increased, the inflation increased, and I think so uh, inflation increase in numbers less than what is actually the real inflation that we see in the market in terms of food and all the consumer durables. So yeah, it's a broad topic, that it's a separate topic that we can discuss some other day. One last question, so since you're being professor for so many years, you must have met so many policymakers from RBI, Ministry of Finance. So, like, how does it, like, you are proposing a new method? What's the probability to get it implemented? I mean, I know it's not easy to just implement, but at least some part of your suggestion is well taken into account, and at least the policymakers and who are in the power in RBI as well as in the Ministry of Finance can at least think about it, and yeah, this is something that can be done in a maybe in a half baked way. I mean, we cannot just transit directly. So what do you think about that? It's just a general question about, like, how why I'm asking this question, because I mean, in US, of course, I have not worked with the policymakers as of now, but I have seen and witnessed that whenever the professors suggest federal banks, they are actually, I mean, many things are being implemented. It may not directly seen, like if you take the example of Larry Summer, I mean, there are bunch of economists that they propose, and they are full-time professors as well as the advisor to federal bank, and I mean, the policies are changed. So what do you think on that in terms of India?
So there are two kinds of policy changes that economists suggest. One are minor, the other are major. So when it comes to incremental changes, minor changes, they are of course heard,
Yes.
and there is an audience for that. The difficulty comes with the major change in policy. Now there's a mindset issue,
Yes.
because you are so used to a particular system, and in fact the more senior you are in the government or in the central bank or even in the academia, what that seniority also means is that you are more used to a particular way of thinking. So in fact, I am having less difficulty talking to you
Yes.
than I have with a person of my age,
Trying to understand
because
what actually happening in the market, like trying to, because
yes,
yeah, it's a mindset which have been there for decades, and I
yeah.
think it's kind of probably people are afraid to new things, and especially in such, because India is such a big economy. If something goes south, like 150 crore people will get impacted. So definitely it's a I mean,
But
difficult.
so in fact, I would put it the other way. Because 150 crore people are involved, we should be very careful about what policies we have been using, and we should be a lot more open to different new policies. Now, I am open to criticism, and if I am told that I am making a mistake, I'll be more than happy to correct myself, to withdraw it. I mean,
Yes.
it's been a great learning experience for me. But in case there is a mistake, I'll be only too happy to correct it. One keeps learning on the way. But if there isn't a mistake, then I will request everybody to, to take it more seriously
Yes.
and not miss it at saying that this is very different. We can't have it.
We can't.
No, that is not an argument.
Yes, but there is also a positive side of it, that India, I mean, RBI policy makers also, like, not just try to copy from Western countries. We have our own, kind of mix and match policy, both from Western countries and from our thinking, and considering our consumer perspective and behavior. So for example, like in terms of we don't do the 100% quantitative easing. It's like half that we do quantitative easing, but not for all the product, like it's only in the bond market, government security. So not, we don't take the mortgage backed security like what US does or Europe does. So I think
So well, to some extent, yes, we have been a bit independent, but specifically on quantitative easing, see, Japan adopted quantitative easing. Subsequently, the US adopted quantitative easing. The ECB, European Central Bank, adopted quantitative easing. They all ran into the problem of the zero lower bound. Their interest rates, when reduced, hit the zero lower bound. In India, we did not face that problem.
yes,
And we did not face that problem because our nominal interest rates are high, and that is because our inflation rate is high,
high,
at least compared to the usual
yes,
targeted
usual
rate
usual rate,
there.
yes,
So, so I don't think we should take a lot of pride in the fact that we did not adopt quantitative easing. We did not have to, and that is because we had higher inflation rates, which is not very good for the public.
yes.
So, I think we should be careful in patting ourselves on the back. Yeah.
Okay, okay. Great, Professor. I think this is a very, I mean, very knowledgeable session. It's for me also, like, since I have read 4 5 of your articles on the new proposed policy, it was quite new for me. And I hope that the audience, also will understand what you are thinking, and especially the students, graduates, and the normal people who try to understand the Indian economy. So thank you so much, Professor, for joining.
Thank you very
Thank,
much. I am very happy to have done this.
thank you. Thank you so much for listening my podcast. Please like, share, and subscribe.